Our panel on stage, you don't have to move, is being moderated by my good friend Tom Kinnear. Tom is D. Maynard Phelps Professor of Business Emeritus at the Ross School of Business at U of M. He was the founding executive director of the Samuel Zell and Robert H. Lurie Institute for Entrepreneurial Studies, former senior associate dean at the Ross School of Business, and former VP for development and executive officer for the university. And he's a super angel. He has pulled together key participants in making a company called Accuri Cytometers a success in every respect several years ago. This panel will discuss the ups and downs for the founder and CEO, as well as the angel investors, in growing that business and bringing it to a successful exit. So we'll pause a few seconds again. So pick the panel you want to watch, move to the session to watch Due Diligence with Brian, stay where you're at on stage to watch the panel on Accuri Cytometers.
Hi, everyone. All of you at the Angel Summit, welcome. This session is to talk about the story of Accuri Cytometers, its funding, its beginnings, its exit, and all the great things that went with that. I want to introduce the panel to you. First, Jennifer Baird, who was the co-founder and first CEO of the company, who went through many of the early rounds of funding and built the company. Walt Young, who was the lead angel investor and brought a group of angels in to fund the company for a significant amount of money over multiple rounds. And to Jeff Williams, who took over in later stages of the company to build it to the point where it could have a very spectacular exit. It sounds linear. It wasn't. It was hard work by a lot of people. And let's get on with it now by having each of the panelists in here just say a couple of words about themselves, and then we'll cycle back and get the details of all the things that went on. But I think you will enjoy this as one that indicates how angel investing really happens. I'll ask Jen Baird to introduce herself at this point, please, Jen.
Thanks, Tom. This is an exciting time to take a little bit of a retrospective on Accuri Cytometers. It's just a bit of background on me. I'm a serial entrepreneur, and Accuri was one of my first adventures, but I continue to lead high-tech, high-potential startups like that in other lives. Angel investors are a critical part of building each and every one of the ventures I've been involved in, and this is a great story of how that works.
Walter, want to talk about as lead angel here? To introduce yourself.
Hi, I'm Walt Young. Back in 2004, I just started being an active angel. I've been a passive angel before. By the way, I was a turnaround guy at 4 public companies for 35 years before. So I was familiar with crisis management, talent scout, but I was not an expert at managing angels.
Thank you, Walter. Well, I'll get to the details in a minute. Jeff?
Hi, my name is Jeff Williams. I'm a startup CEO. I've done that since 1996. I've been a CEO of startup companies for 24 years now. I've done 6 companies, and Accuri Cytometers was my 3rd company.
Okay. Welcome, everybody. I should note that I have been playing in this field for about 30 years now. It scared me to say that to myself. So Jen, can you start us off and talk about the founding of the company, how you and Colin put it together, and how you thought about the company, and then how you went about getting the first set of angel money?
Right, absolutely. So in 2004, Colin Rich, who was my CTO, and I were looking for an adventure to go on, and we found some technology at the University of Michigan, which we licensed and explored how to apply it in the flow cytometry space. And the reality was neither Colin nor I knew what a flow cytometer was when we started the company. But we learned along the way, and we did some groundwork for about 9 months before we actually started raising money. And that was back in 2004, when it was essentially 2 people around a kitchen table trying to figure out whether there was a real need there. And what we uncovered, and probably one of the most important things, was that when we talked to immunologists, who are the primary users of flow cytometers, And a flow cytometer, for those of you that don't know, is a life science research tool that's used for evaluating blood characteristics. And so when we would go and talk to immunologists, the first thing they would say when we described our product concept was, I don't believe you. When can I have one? And when they said that, we knew two things. One, they didn't believe that it was possible to do what we were proposing. But if we did, they wanted one. And that was, we had that conversation with probably 25 or 30 people to get convinced that indeed there was a need. And then there was a development of the technology concept at that point. And then we really, to build that out, needed to raise some money. And we started that process with essentially 5 people who had a lot of engineering talent, and started talking to potential investors. And one of the first potential investors that we talked to early on was the group that Walt was part of at the time. And so this was in 2004 that we were kind of laying the groundwork. By January of 2005, we managed to close an $800,000 round. Now, for a long time, it didn't feel like we were going to get to $800,000. And then, of course, there was the rush at the end when it was supposed to be $750 and it got to $800,000 with 14 investors, I think, including you, Walt. You were there from the very, very earliest part. And I remember actually having a conversation with Walt at the very first part. And I can tell you a little story about Walt. We were in a conference room that we had borrowed from another startup CEO to meet with Walt. And we talked to him about what we were thinking, and he asked a whole bunch of really a wide variety of questions. And I remember when Walt left, I looked at Colin and he looked at me and we said, I don't think he got what we were talking about at all. And the very next day, we got a vintage Walt item. We got 2 pages of Walt's notes in which Walt demonstrated that he had totally gotten absolutely everything and had highlighted all the strengths and weaknesses of what we were doing. And we were a little blown away by that. And that was the very beginning of our relationship with Walt, because I think he got convinced at that point that there was something worth doing. So I tease it up for you, Walt, to tell your side of the story.
Well, that Colombo Act, before that, Jen, there were a couple of years, even before you and Colin, that technology came out of U of M and the tech transfer. They screwed around for 2 or 3 years before you and Colin turned up, as I understand. But you attacked me. Ian Bunn set you and Shiram, the 2 of them set me up to attack me in a Dave Brophy class. You remember that?
That sounds vaguely familiar.
And that was before I sat down with you and Colin and did the Colombo Act. But then she had the 3 of us, Shiram, myself, and Tom Kinnear on the board. That's when I first met you, Tom. But no, she wrote me in. I have been a member of Plymouth Venture Partners and the famous Ian Bunn. So he sucked me in to suck in more angels. And that first round was a tough round to get to that 800,000 that closed in early 2005. Mm-hmm. Now, with Jen and Jeff, we had at least 4 stages. The initial concept stage, the commercialization or ramp up stage, and the exit. There's only 3, I guess. But you had exciting stages, and the angels stayed up. I think we raised $38 million in total, Jen and Jeff, about $7 million in debt, and the other 31 in equity. In
that
about
total,
6
Walt,
rounds.
concluded the VCs. The angels did about, was it 8 million, Walt?
I think it was pretty equal. We had angels and 5 VCs over the 7 years for that total of 31.
I think one way to think about it, though, and I think this is important from how the angels experienced it, right? Because we raised $800,000 in January of 2005. By August of 2005, we spent that money and we needed to raise more money. And so then we raised, and that first round was a Series A. equity round. Then we raised a convertible note for 1.5 million in August. And then another 8 or 9 months later, in May of 2006, we raised another 2 million. And in July of 2006, we topped that off with another 560 million. So by the time we reached what became our first venture round, we had actually raised almost about $5 million from the angels before we took any VC money. And it was in a course of like 3 or 4 rounds. And so I think the angels started to feel a little traumatized by the number of times we kept coming back and saying, please write another big check. And that was pretty much an adventure. When we started down the path of raising venture capital from venture capital firms, there was a moment in time because we were several years into the product development. We were already starting to do beta testing. And at the time, we had a beta test that didn't go well. It surprised us and we learned something at the time. But the problem was we were in active negotiations with VCs. And because the beta test didn't go well and the people we were doing the beta test with happened to be have investors of one of the VCs we were talking to, it got back to the VC we were talking to. And I remember having a very hard conversation with the lead VC who basically cut our valuation in half and went from a flat valuation to a down round, which caused much trauma and consternation and angst amongst everybody that was involved. And we had to make a hard decision at the board level of whether we thought we actually had something that was going to be good commercially and we should keep going, or we had a contingent of angels who wanted us to just throw in the towel at that stage. Thank goodness we all stuck with it because in the end it turned out well, but at the time it was the dark days.
Jen?
Walter, can you comment on the kind of the opportunity that goes with a down round if you're an angel?
Yeah, no, 3 or 4 items there. Number one, for all angels, when anyone tells you this is the only round and we will have no other, don't believe them. I think we had a total of 15 rounds with all the convertibles and everything else in the 7 or 8 years. Okay. And so don't invest all you're going to at first. It's best to spread it out. Number 2, when you bring in venture people, or even when you bring in more angels, be aligned and make sure you all have the same understanding. I explained to all my angels what passive angels mean. And I learned that at Accuri because I didn't know. I had some active angels that were uncontrollable. Next, when you're talking about alignment, when you bring in VCs, the same goes. Some VCs want to get out quickly, fast. Some want to hold on. It's best to make sure you're aligned. Now, on the down round that Jen mentioned, I remember that specifically. Tom and I were sitting across the board table and we looked at each other, the eyeballs. It was an Oshett moment that here we were on the B round, down round for angels is not good. But I have to tell you, down rounds are an opportunity. I've made more money over down rounds over the last 20 years than on straight rounds. If you know the operation, you know their future, everybody has speed bumps.
If you believe that it was temporal problem and not a systemic problem, that's the time to buy again more because it's now worth half what it was before and a chance to get in. Maybe it's good to ask Jeff, not about Accuri, but Jeff, you had some other companies that experienced some bumps in the road, like down rounds that worked out super well too. Do you want to comment for angels on that before we get back to Accuri?
Yeah, I guess the one that would come to mind, maybe it would be HandyLab.
HandyLab is what I had in mind. Yeah.
Yeah. So yeah, HandyLab definitely had the same sort of issues that Accuri did. As far as it's never, well, sometimes it can be from point A to point B in very linear, but that is typically not the way that startup companies go. Typically, there's some bumps in the road. You put together the best plan you possibly can. You try to execute that plan, and there's often issues that crop up along the way. It always seems to take more money than you think and more time than you think. And Handy Lab had other issues too, where there was, I think, the big one was the board and the management team at the time completely disagreed upon the strategy. And that's, not a position you want to be in, where the management team thinks it's going one direction and the board thinks it's going in a 180-degree opposite direction, where they didn't even have alignment on what the company was going to be when it grew up. So that obviously is difficult. I don't believe Accuri ever had that issue. I mean, the name itself, Accuri Cytometers, kind of said what the company was going to do. So luckily, we did not face that dilemma at Accuri.
Walt, do you want to come in more detail about sort of how angels should think about down rounds when they?
No, I think Jeff, and you said it, look at the fundamentals in the future and expect speed bumps. As Forrest Gump said, shit happens. And that it's better to know it earlier. And frankly, at Accuri, as I remember, it was before we made major commercialization effort. And so it came at the right time. You don't want to have it when you're going full bore on commercialization. You lose your reputation and earnings. So if you got a speed bump, do it before your commercialization, so you don't lose your reputation. So our timing at Accuri was good for our problem, and caught itself. All it cost us was probably another 3 or 4 million, and a year, Jen will probably say. And I better sneak in, at Accuri was one of the more efficient, I think, for the development stage, Jen. It was a total of like 10 million. And not even that.
It was less than that, because it was, we launched with the Series B money, and
right.
That included the 10 million. So we got the product development done for 5. And then we did that Series B. The thing that Series B was really important, and this is kind of what you guys have been alluding to. We ended up doing 8 or 9 months of beta testing and refining the product before we actually did a commercial launch. And I'll be honest, I was the one who wanted to launch. And it was people like my experienced angels like Walt and Tom, and some of the VCs were like, slow. And they were right, because there did come a moment when it became very clear that the product was ready and the customers wanted to buy it as it was. And that was an important learning. And that was what we got out of that down round, to be honest. We learned that of a couple of things we didn't know about the product, had to fix them before we launched. But then once we launched, there was a crazy time when I remember very distinctly, we had money from our new VCs, and we launched our product, and we hit kind of maximum, what ultimately was maximum burn for Accuri. And it didn't last very long, but there was a point in time when we actually were burning $1 million a month. And I remember everybody was feeling a little terrified by that. But you could see the end of the tunnel coming, because the commercial momentum was building, but it was rather heart racing for a bit.
Yeah, now you jump forward in time.
I did, sorry.
But in the early stage, we only spent 10 million before launch, and that's very efficient. One of our problems was telling VCs that we were interviewing and looking for that we only spent 10 million to develop a whole product. And to that, it was incredible to them. And I have to say, Michigan and the Midwest is a very efficient place to start up new companies. But that 10 million on either coast would have cost 50 million. And we did. We had a company, Guava, who spent close to 50 million on the same product and couldn't come deliver anything. But no, getting on to it after the launch and commercialization, that's when we were hitting high burns.
You might want to note, in this particular case, the delay was technical, and it was a technical problem that we knew we could solve.
Yes.
And the market was ready, as opposed to having a great product, you think, technically, and the market doesn't care. So the angels that stuck with it were the ones that believed that we had a real product eventually within time frame, and the market was going to be fantastic. But some of them bailed. Walt, you want to talk about this is not for everybody? A little bit of the.
Well, no.
We made eye contact, but we also reached for our wallets, as I remember.
Well, no, we had to ante up. One of the true believers, like Tom and I and 20 other angels. But we had some dissenting angels that were a real pain in the butt.
No
I think
names,
that was,
please.
huh?
No names.
Oh, I don't know.
No.
No names. Okay. I'd love to. But we left them in the trail and parted. But I have to say, one of the things that Accuri did, and Jen and David Olson, was always the voice of the customer. Even before design, they interviewed customers and thought like customers for the hardware, software, and that was one of Jen, your secrets of success. It was customer driven right before the get-go.
That's true. There's so many ways that we were very deliberate about building that customer voice in, and it's what meant that the product was something the customers wanted when it was built. And it's a place that you see lots of startup companies not do a good job, because you think that you have a good idea for a product, but if your customers aren't the ones shaping that idea, they aren't going to like it when you're done. And we had that from inception and then all the way through. We did a lot of things to try and make sure that that customer voice was loud and clear all through product development and then through marketing.
And we had a great marketing head on the board, Tom Kinnear.
Well,
Yep.
Jack Ball was the important person.
No, he didn't come
inside the
in
market.
yet. Way before Jack entered,
That's true.
we had a
You're
marketing
a
focus.
commercial guy, Tom.
I'll slip you the money later, Walt. Jen, there were a couple of more funding rounds where the angels stayed with. Walt talked about the tough times where the angels stayed with it, a group of them.
Right.
But you also did a couple of more funding rounds with VCs before Jeff came in to do another round and then sell the company and grow it and sell the company. But can you comment about what the dynamic with the angels was as you then did later rounds?
Right. There does come a point, and a lot of times it's the point when the VCs come in, where if you're not an angel that's in the company already, there's no more opportunity. I find that something that seems like some in the angel community have the impression that once the VCs are in, they'll get an opportunity to come in and follow the VCs. I haven't found that to be the case.
No.
So you're not in you can continue to invest more in a company you're already in, but once the VCs are in, no new angels.
You want to make sure as an angel you have pro rata rights to do so going forward.
So that's an important thing to be aware of. So when we advanced from our angel phase to venture phase, we had 53 angels that were in the company at that point. And then we raised our first venture round was a $5 million Series B, and that helped us get through the beta testing and initial commercial launch. Then we raised a $13 million Series C, and I'll just jump ahead, a $4 million Series D, another $4 million Series E before the exit. I think that's about right.
I think Jeff was involved with the E, if I remember.
He was absolutely involved with the E. And the thing that I think was important about those rounds is at each point we brought in additional investors. But because Accuri was having greater and greater success, the rounds the balance of power in the rounds shifted. And we had more control over who we brought in. But the Series C was pretty important. In that case, we brought in 2 Boston-based venture capital companies. It was a very, very intense raise, and we had all the angels and Series B investors, venture investors, campaigning to get the Series C investors in. We did manage to create a situation where there was some competition amongst different VC groups. We ended up going to Amsterdam as part of that race. And we did get some really good feedback. But that was a commercial scaling raise. that was a lot of money that we needed to actually grow the company. And I think sometimes people have the perception that a lot of the money that you need to raise is about the product development. But one thing you want to be aware of is it's all about the commercial effort. And let me just give you a couple of numbers. We went from 2 to 18 people before during the product development phase. When we went into full commercial, we jumped from 18 to 46, boom, overnight. And you talk about the burn, because now you have to actually have people going out and sell. This is a fairly long sales cycle product, and and we had to figure out how to make it. All those kinds of things were issues that we had to work through, and they cost a lot of money. And you don't want to push for premature commercial team, because it just costs you a ton of money if the product isn't actually ready to go.
Jen, you want to comment just slightly on the early rounds were mostly about tech, the later rounds were mostly about commercialization. And do angels understand, in your experience, the distinction between that and what the money's being used for and how they feel about that? Do you have any comment on that?
Go ahead, Walt.
Oh,
I'm going to ask
most do. And I've screened my angels since Accuri to make sure that they do. If they don't, they aren't an angel in the Friends of Walt. And
affectionately known as FOWs.
And I have power of attorney. If they misbehave, they get slapped on the wrist. But I have to highlight, Tom, what you said. Angels need to get in the early rounds so they can participate in the later rounds. It's not that you can just wait and pop in at the end. Neither the VCs nor, frankly, the lasting angels want to let you in on good companies.
Walt, you might want to comment on that structure, because VCs generally don't like a long cap table full of angels. So that was true in the old days, but now Walt's structure he's talking about, which is that one lead angel might have the power of attorney for the others. So that's a simplified discussion with the VCs.
And that makes it easier for the VCs to accept. And I got that track record of controlling angels. And let me slip in here, Tom. My 3 things that I look for entities, and Jen had them all, is number 1, leadership, that they're aligned, greedy, know how to connect the dots. Number 2, that they have a unique product or service proposition. And 3rd, and surprisingly, they got to have adult supervision. Everybody needs a boss. Even people like Jeff and Jen.
Maybe we, with you mentioning Jeff's name, we should get to a later part of the story at this point, and then we can cycle back and interact amongst ourselves. So, Jeff, you came in to a successful company, but needed to grow to the next level, and then set itself up to sale. So, do you want to just comment sort of what you found and where you took it, and what your thinking was as you came in about, as you prepared to run the company, but I think you also in the back of your mind maybe what it would look like at a sale at that point. So would you like to comment, please?
Sure, yeah. Every venture-funded, angel-funded company is going to be sold. A few of them may be IPO, but really over the last 15, 20 years, you have to essentially assume that they're all going to be sold. And every venture-funded, angel-funded company is always for sale. So they may say they're not, but you're always for sale. If somebody comes up with the right number, it's your job to maximize the return for the shareholders and to sell the company.
You have a fiduciary responsibility to do so, basically.
Absolutely. And so that's always, even from day one, when I do a startup company, you have to be thinking about that. You have to be thinking about the exit. Is there a viable exit? And when I was asked to come in and get involved in Accuri, I liked what I saw. There was the space that it was in is life science tools, and that's an interesting space because it's it's not an oligopoly. It's not, dominated by one or two companies. There's actually many, many players in that space. And often what I'll look at is the buyers. How many potential buyers are there? And I liked what I saw there too, that there was really 5 or 6 legitimate potential buyers of the company that really had the wherewithal to acquire the company. And at that time, this is back 2010, I guess, most exits were between $100 million and $200 million. And so you have to look at how many potential strategic partners out there can do an acquisition of that size. And again, I like the numbers. And Jen and Colin had done a really good job coming up with a unique product concept. As you said, it met a need. And I love the better, faster, cheaper business model. Take something that's already been done and just do it better, faster, cheaper. And that's exactly what the Accuri C6 was. It was a smaller product, a smaller instrument that definitely was a lot more cost efficient and could actually penetrate a much larger market because you put individuals rather than core laboratories. So I liked where it was at and I decided to get involved. And as I said, Jen and Colin had taken it a long way. And so it was really much more focusing on what do we need to do to kind of polish it up and take it to the next level. And that was really mostly around manufacturing scale up. So we had to be able to make a lot of them and get a potential acquirer comfortable that when they came in that they would be able to understand the documentation and understand their quality control system and understand the nuts and bolts of producing lots and lots of these products. Really expand the revenue, and that was pretty easy to do. Jen had done a great job in the U.S., and we really just took it international and leveraged international relationships with international distributors. We also took the same product and tweaked the software a tiny bit and made a clinical product that we prepared to launch, and in doing so, really kind of expanded our potential market opportunity. So I think gave us a multiple on value when we did that. And then really, the last and final step, selling, but the major step then is getting the company where the cash burn comes down, you get it to EBITDA positive, and doing that through a combination of growing revenues and keeping control of the costs was effective at Accuri, and we were able to actually increase revenue pretty significantly, keep control of costs, get cash flow positive, and then we had a couple of different companies express interest in acquiring the company.
One quick question before you go to the details of that, Jeff. Why did you raise one last round of venture? Because it wasn't a very big round, but you did raise one more round.
Wow, Tom, you're asking me to remember a long time ago. I think
I'm a lot older than you. I shouldn't remember anything.
I can remember.
Maybe Walt needs help. That was my 3rd company. I'm on 6 now, so I've kind of lost track of all the different rounds over the years.
Go ahead, Walter. Let's finish that off, and then we'll get back to
No. Jeff proposed it. And it's common. You don't want to run out of cash when you're selling the company. You don't need to lose that leverage. So it's sometimes called show cash, that you need to put cash on the balance sheet so that you aren't in any rush, and that all the strategic buyers know you can string them out. You don't have to sell. You don't have to have another round. So early on, or, a year before exit, in this case, we did the showcase round. We didn't need it to make it through, but we needed that durability to help Jeff get the price.
To tweak Jeff's memory a little more, there are a lot of companies knocking on the door, VCs knocking on the door at that point, wanting a piece. And I always quote you, Jeff, which is, you can never have too much cash, quote Jeff Williams. And so maybe we stimulated you to remember. Can you talk in more detail about how you orchestrated the exit? And Walt, maybe you can comment from the board perspective, how the board members and angels were looking at it at that point. We had a bunch of VCs around the table then too.
Sure, yeah. I mean, the timing worked out obviously extremely well. I don't think any of us anticipated selling the company quite that quickly. I think we were probably looking more 2012, 2013, and we were able to exit in 2011, I think March 2011. Ideally, you don't want to approach anybody. You want them to approach you, and then retain a bank and run an auction process. And we were fortunate we were able to do that. So the company continued to make the milestones that we set out for ourselves, continued to grow and improve the processes that we wanted to improve. And I'm a big believer in always showing your competition what you're doing, because first of all, you should be proud of it, and you should be able to believe that you can outcompete them. But secondly, your competitors are your most likely acquirers. And so we were at a trade show in the fall or summer of 2010 and started talking with one of our competitors, but also potential acquirer. They expressed a lot of interest in what we were doing and asked to see the progress. We invited them into the company and spent some time with them. And it was obvious that they were interested. So we asked them if they were highly interested to provide us with a letter of intent that, as a venture funded company, as I said, we're always for sale. And if they gave us the right price, we would be willing to consider that. They put forward a price that was interesting enough that we decided to retain an investment bank and run an auction process and see if other parties were interested, which is really the preferable way to do it. Get a stalking horse, then get an investment bank, and then run a process and try to increase the competition. So ultimately, the party that initially expressed interest did not acquire us. Another party did. So it worked out really well for us that we were able to show them that the company had reached a stage of maturity that it made sense for them to spend quite a bit of money on acquiring the company.
Go back to what you said earlier, Jeff. Were there about 13 companies with some minor or major interest in the beginning? It was whittled down to 5 or 6 and then down to a few as you worked.
That sounds about right. Yeah. I mean, at the end of the day, we had, I recall, 4 serious bidders. Then it came down to 2, and then it really came down to 1.
But the key to what you said earlier about being in a business as you invest as an angel, knowing that there will be multiple acquirers potentially out there.
Yeah, absolutely. I see lots of startups where I look at the business plan, and the first question I ask myself is, who's going to buy these guys? And often you'll talk to the entrepreneur and they'll say, well, I'm going to take it public. And it's like, well, I'm not interested in investing, and no one's going to, because the probability of you taking it all the way, getting an IPO, and then the investors getting out with a positive return is small. The option A has got to be a strategic sale.
Yeah. Walter, do you want to comment on as a board member at the time and as a leader of the Angel Pack?
Yeah, Tom, a couple of things. This is where adult supervision of the board came. Number one, on the management change. And here's Jen, who had built up a great company, revenues of 20 million, high credibility, reputation of the product. The value was recognized, and we changed CEOs. It's almost like a baseball analogy. Jen was a great startup and ramp up CEO, and Jeff was a great closer. In 1 year, Jeff, and he said earlier, it was not just the process of an exit auction. He did, with the same management team that Jen had assembled. You didn't make one change, Jeff, as I remember.
No.
That he added value by ramping up the manufacturing. Steve Chipchase was a great asset. The marketing had already led with Jack Ball. That he added the roadmap for a strategic buyer. He developed a clinical product, a clinical roadmap to the volume. I think to this day, if you had BD on the panel, they are happy with what they bought. Jeff, do you know what their revenues are now, 10 years later? I think they're,
I do not, but I know that they're very successful, especially the clinical product in Asia and Africa.
Right. No, I think they're well over $1 billion in revenues because they followed that roadmap.
This is what
I have to sneak in here. Celsey's probably going to ruin them, but okay.
So this is why a good strategic buyer, why they pay great multiples, because they can see what you have and know what they can do with it in their system, as opposed to selling to a financial buyer who's going to get some whiz bang from Wharton or somewhere who doesn't really understand entrepreneurship and calculate it on some discounted value of EBITDA, which is, if I remember Jeff's words, I'll quote you again, sell on exponential sales growth, as I think is a Jeff Williams quote. Is that, am I quoting right, Jeff?
If you can time it, that's
Jeff, not only did you do the operational side before the exit process that you outlined, but do you remember one phone call you and I had? I think I was on the South Island of New Zealand. And I said, you need to change your gender or something, Jeff, unless you got more than 200. You remember that?
I think while you said
believe
you
all.
were going to change his gender, if I remember.
Yeah, something
correctly.
like that, Tom.
I believe you all. I do. I recall lots of conversations, but I have a hard time recalling that one. But I believe it's absolutely true.
Okay, well, we're coming up close to the time that was allocated. Jeff, Jen, Walt, anybody want to add to this that would add perspectives to the angels who are observing our conversation?
I think it all comes down to people. You've seen Jen and Jeff here, but the team that Jen assembled was really our secret, Tom, of accomplishing all phases. Colin on development, the marketing team, there were 7 or 8 people, other than the 4 of us, that really are there. Now, success has 1,000 mothers, but I think Accuri has 10,000. You said we only had 80 employees?
Yep.
With the success that we had, I think there's over 2,000 people that claim to be involved in Accuri.
That's true. I hear from them all the time, actually. It's really funny. I actually, just this last Christmas, got an email from somebody from BD, an application scientist, who sent a note to me, and he said, "Thank you for founding Accuri. I have the privilege of selling this product into the market every week, and it is still a game changer a decade after we sold the company," which is really an amazing thing, because I don't know what he had to do to come find me on LinkedIn to send me that note. But it does emphasize the fact that the product is still out there, and the people who are selling it are still happy about selling it. And from what I've heard, there's certainly been improvements made to it, but it is still the same product, same basic product that we envisioned back in 2005 and then built out. So I think that makes a huge difference. I also think I would emphasize and echo what Jeff said, is you're always thinking about the exit. And I remember conversations Jack Ball and I had related to, I don't know if everybody remembers, but we had this Reinvestment Act, which pumped up the life science companies in a big way. Jack and I always believed that when that money rolled off, that the life science tools business was going to be looking for new things to plug in. And that's exactly what happened. And just about the time that Jeff joined, we saw that effect starting to happen. And there was a lot of interest. And I remember handing off some good opportunities to just feeling like the whole thing was really having momentum at the time. And I'm very thankful for Jeff shepherding that across the finish line in such a good way.
I have one more comment about that, which was the sale price was such that if you looked at the waterfall of who got what, because often the rounds after angels are in have preferences associated with them that get in first in line, that you're always looking as a board member or as an angel, what flows down to your level of investment and, quite frankly, to the common shareholders, which is what founders typically have. And salute to Jeff and Jen and et cetera, that the number there allowed in this case for us to all be smiling, because what flowed down, angels should know that sometimes people come in after them, that the preferences take all the value away if you can't get a great exit. In this case, that's what makes it a great story. Despite all the hardships along the way, the bumps in the road, I guess is the term we're saying, the exit was such that everybody comes out a winner in this particular case. So therefore, a great example.
Don't expect 6 exits all the time.
Damn,
But
Walt, it was 10x, Walt. It wasn't 6.
Oh, okay. But
No, don't. We all could have
Don't
we could have a panel on losers if you like too, but that
Oh,
would
no,
takes
no.
skill. It takes skill as well as a bit of luck, as Jen said. You need both together.
Well, Jen is on her 3rd company as CEO, and Jeff's on his 6th, and Walt and I are still trying to play this game somewhat.
I'm on 102, Tom. Okay.
Well, I can't count that high. Well, thank you for watching our discussion here today. Hopefully it was helpful to you, and we'll look forward to answering any questions you might have. Hi, everyone. It's Tom Kinnear, and we welcome your questions at this point in time. Thanks to the panel members, and we're open for questions. If they're, put them in through the chat. In lieu of those questions coming in to start with, we might want to talk a little bit about one of the questions I think all of us are interested in is we gave you a history of something that happened, ended a decade ago, 9 years ago, and whether angels and VC funding and the whole dynamic of exits has changed in that interim. And we've all experienced that in the last decade. So I'm throw it to whomever wishes to go. Jen, do you want to lead us off? Because you're in the middle of raising money right now.
Well, actually, I'm not, but I did raise money last year, thank goodness, before COVID, and I'm really thankful for that. But I did notice that when I was raising money for the company that I'm leading now, that there seemed like a shift towards people being more conservative from when we were raising for Accuri. People in the angel community, as well as the VC community, but particularly the angel community, were looking for the kinds of things that the VCs were looking for back in Accuri days. There was a lot less boldness amongst the angel community. Now, I did find a bunch of angels that were willing to jump in early and get excited about what we were doing. And honestly, we raised our first VC round, and there was not that second opportunity to get in. So I think that it was interesting to see some of the Accuri investors who were like, well, we want to see revenue before we invest. And I thought, wow, that's not the point at which I'm going to probably be raising angel money.
Jeff, do you want to comment? Because actually we got a question coming in through the chat that deals with this issue. How has it changed in terms of the mechanics and the whole attitude about all of this? You just exited a company this week, which is great, but you funded it from scratch after Accuri, and you went through a whole different set of funding.
Yeah, I guess the biggest change that I've seen in the last 10 years in funding is probably the size of some of the venture funds, and especially in the life science space, the change that we've seen where a lot of the life science specific venture funds are out of business or defunct. And generalist funds have stepped in some instances, as well as strategics. And so you're seeing lots of deals where a lot of the funds want to put in $20, $30, $40 million right up front into a deal. So I think that's been the biggest change. I think it's probably harder right now to raise, say, a $5 million or $10 million Series A than it is a $40 million Series A. And that's I'd say a big difference in our industry, where it's the game has changed a lot dramatically. There's a lot different different number of players, but also different type of player that are investing in these sorts of companies now.
Walter, you've done a lot of angel during this time frame. Do you want to comment to the changes over the decade?
Tom, I'd say across the board, everyone's gotten more conservative. Angels, venture funds have gone later, and strategics have consolidated and gotten more conservative. So versus a decade or so ago, in the life sciences, it's changed. Now, what I found in the last 3 years is going from angels to the next step, to the B and C, is family offices have stepped in. And they'll do, 4-6 million chunks right off the bat. And and they syndicate well, where VCs are even later. And as Jeff said, there's less of them. So it's gotten more, angels are more critical for the seed rounds and A rounds. But angels have to remember they want to have the ability to stay in for all rounds and look out for those down rounds to participate in.
Well, you just did an exit of a company that you were heavily involved with that was family offices that carried a Celsi, we just exited too a little while ago.
Yeah, we brought in 3 or 4 family offices, and they're more aggressive and risk-taking, and they're more oriented to specific sectors, so they know what they're talking about.
Yeah. Do you find that the angels that you've worked with all these years are also more conservative?
My group has changed. It's aged, but it's expanded. I've gone from 20 to 50 or 60 angels in the network, and they're not your typical angels. Higher net worth, and they're a little more risk-taking than the initial angels are. But my angels are all known to be passive. I train them to be passive so we don't have 50 active angels. Jen would love that. Sounds like she's got too many active angels now.
Well, Accuri,
nope, I've got well-trained angels. Well,
oh, that's the best part.
Accuri definitely did have too long a list of active angels from the mechanics of what we were trying to do.
Yeah, I learned at Accuri.
So did I.
To make alignment. Alignment is key between management, investors, and there's a lot of things that you can do in the structure to make sure that alignment happens.
One of the dynamics that may have changed somewhat, and 2 of you have direct experience in the last 6 months about exits, of the exit mechanics that you discussed, for example, Jeff, in Accuri, were they different for the exit you just executed? And then Walt, maybe you can comment on the Celsi exit too, because they were somewhat different than the story that we just told about Accuri.
Yeah, I think it's been well characterized that exits are taking longer now. That it's very rare for a company to go from, in our space, to go from conception to exit in, say, 5 years, or maybe 20, 25 years ago, that was kind of common, that a strategic would come in even definitely prior to commercialization, sometimes right after feasibility, and would acquire the company because they would want to put their print on the branding and the initial scale up to commercialization. And now companies definitely are going later, where they want, a lot of the acquirers want to see 10, 20, 30, $40 million in revenue before they do the acquisition.
Yeah, I know, Tom. Celsi was more on technology than revenues. And so it was unique in these times. Jeff is right. Anything under 20 million, strategics don't like to look at unless you have technology. And Celsi, we only had like 2 million revenues. So the multiple on revenues was sort of crazy, but because it was all on IP and patents, and the roadmap ahead was pretty clear, short term and longer term.
Yeah, we've got another question, which I think is a really good one about, angels invest early, and then with all the rounds that follow, the question relates to how is your valuation given all the later rounds might have some liquidation preferences and all those other kinds of things, and how do you keep the early shareholders from being clobbered other than pro rata rights, and they're continuing to put money in? Comments?
Let me just comment here, and Walt and Jeff can correct me, but I think for the Accuri sale, pretty much all.
Jen froze.
We lost you, Jen.
Well, we can fill in what she was saying. Go ahead, Jen. Are you there?
I am. I don't know what happened there, but I think that all of the investors in Accuri, kind of across all the stages, ended up with cash on cash returns in the same range.
Right.
Yeah, but that was because the exit value was high enough to make that happen. And that was one of the things we really looked at was the waterfall table of who got what, which should be a big concern to every angel who puts money in. That's why you want to continue to ride the parade. But Walter, Jeff, you want to comment on that too?
And most of the angels in Accuri had enough firepower, ammo, to participate in all of the rounds. And so that's one reason. The other reason is with VCs that came in, and we had 5, it was understood that all the rights would be protected. And so they could participate all the way through.
Yeah.
Those two things.
I have to cut you off, Walt, because we're getting to the end of our time. But
okay, Jeff.
We should say, just in fairness, that doesn't always happen.
No.
But I want to wrap this up now. I want to thank the panel. Thank everybody for listening and being part of this. Certainly any of us would probably be glad to answer other questions if you want to email us directly. And I think we're headed back over to Skip.
You are indeed. Thanks, Tom. Jen, thank you. You're always one of our go-to people, and you always make yourself available for these things, and we're really grateful. And I'll give you a plug for your blog. I see you on LinkedIn all the time giving entrepreneurs advice. Highly recommend that. I've actually grabbed a couple of them and we've put them on the Spark website. Great advice from a founder, multiple founder. Walt, great to see you again. Looking good out there, young man. And Jeff Williams, thank you. You were one of our first serial CEOs for the area. We need more of you. And I'm sure you're willing to mentor other CEOs around to help companies get to that last step, make that last mile. So anyway, this morning has just flown by, at least for me anyway. I want to take a minute though to remind you that this summit is just one of many events occurring throughout this week that we call A2Tech 360. Check out all the events at a2tech360.com.